Okay, so this next video lecture is about our Module 2 for Accounting Information System class. So this is entitled Introduction to Transaction Processing. So in this module, you will be able to understand the fundamental concepts of transaction processing in a business economic activity. So you will also learn about the basic documents, process, and the models that are commonly used in recording financial activities of a business enterprise. Okay, so here our learning outcomes is for you to understand the broad objectives of our transaction cycles. You will also understand the difference between financial and non-financial transactions and also know the principal features of the general model for our information systems. Also, to recognize the types of transactions that are processed by each of the three transaction cycles that we will be discussing. Know the basic records that are used in the transaction processing system. Also, to understand the relationship between traditional accounting records and their digital equivalents in the computer component systems. And also, to be familiarized with the data coding schemes used in accounting information system. So for our content, so we will be discussing about the overview for our transaction processing, the accounting records, the file structures, documentation techniques, transaction processing models, and our data coding schemes. Okay, so to start with, let us discuss the overview of transaction processing. So here, basically, you are aware that in a business enterprise, we always encounter financial transactions. So basically, this is what we record in the books, okay, of our accounts. Okay, so here, financial transaction is also defined as an economic event that affects the assets and equity and other elements of our financial statements, okay, or of the firm. And this is reflected in the accounts. This is also measured in terms of its value or monetary terms. So similar types of transactions are grouped, okay, together in these three transaction cycles. So in the different financial transactions, okay, to make it easier for an enterprise or for a firm to understand how each process should take place, as well as how to document it or to record it. So this grouping was created, okay, because there are financial transactions that affects other accounts, okay, or other elements of our financial statements. So that's why they are grouped together. Or in other words, there are transactions that affects one or more accounts. So that's why they are grouped together, okay, because they belong to one transaction. So basically, we have here the three types of transaction cycles. Okay, so we have the expenditure cycles, conversion cycle, and the revenue cycle. So this is the main or the three main transaction cycles that takes place, okay, and occur in a business firm. Okay, and usually our financial transactions are also recorded. Okay, so we have here the illustration for the relationship between the transaction cycles. So basically, if you can see here, from the beginning of the transaction or in an enterprise, okay, so the aim or the end product that they would want to achieve is having revenue. But before they could have their revenue, first they have to spend. Okay, so meaning to say the first transaction that will take place is the expenditure cycle. So in this cycle, it involves the putting together of the different elements of capital and production, okay, to create a good or a service. So again, this is the premise of uh, earning a revenue. So again, it would the firm should first spend, okay, for them to create a product or service that they can offer to their customers, and in return it will bring them revenues. Okay, so that's why if you could notice here, revenue cycle is the first item in our transaction cycle illustration right here. So in the expenditure cycle, um, we mentioned that an entity needs capital. Okay, so capital normally that is uh, initially in the form of cash. Okay, so they will use this to purchase the necessary materials that are needed to pay for the labor and other assets needed for production, okay, or in the conduct of their business activity. So here, aside from cash, they can also have or acquire these necessary elements through credit if they will be allowed. But basically, cash is the main source of putting together these elements. Okay, so this labor, materials, and physical plant are being used, okay, in the production. So in our production of the goods that we will offer, so this is where the conversion cycle takes place. Okay, so basically here it will involve the cost accounting, okay, because costs of the production should be monitored and controlled, okay, also to fix the selling prices. Okay, so after the raw materials, the labor and factory overhead and other elements of production are transformed, okay, into finished goods, then it will now be ready to be sold to our customers, and it will be uh, a source of the revenues now. Okay, so our revenue will be the source of the cash, okay, of the entity that they will use again for the expenditure cycle. Okay, so that's what they will use in purchasing the needed raw materials, for paying the labor and factory overhead and other assets that are needed. So this is how a transaction in a business enterprise takes place, and these three transaction cycles are conducted, okay, and where the financial transactions also are or where the financial transactions takes place, that we need to record in the books of our accounts, okay, and this is how they also relate with each other. Okay, so again, our three main transaction cycles is the expenditure cycle, conversion cycle, and the revenue cycle. Okay, so for the sub-cycle, okay, so we have here the other supporting explanation also, okay, of the illustration that we have earlier. So for the expenditure cycle, of course, there is time lag between two due to the credit relations with the suppliers. So this is in relation to the physical component or the acquisition of the goods, and the cash disbursements to the supplier. So of course, again, this will depend upon the availability of cash of the entity to pay for their inventory acquired from the seller, okay, or the supplier. For the conversion cycle, the production system, okay, so this is where the planning, scheduling, control of physical product to the manufacturing process takes place. So, of course, as mentioned earlier, our cost accounting system will help the management to monitor the flow of cost information that is related to production, and at the same time, this will be used later on for controlling of this cost, so to maximize our profit. And for the revenue cycle, so also there is a time lag between the credit relations with the customer. Okay, so sale of these goods, finished goods, and the receipts of cash, especially if the entity is extending credit to their customers. So cash conversion cycle is also very important because the entity needs cash, okay, uh, to to manage or to perform their activities related to the expenditure cycle. Okay, so this is how our transactions takes place in a business entity. Okay, so those are for our transaction processing. So basically, this is just for a simple and typical business entity. But again, the cycle, the transaction cycles, and the activities that relates to it will also differ according to the nature and type of the business. Okay, where the entity is engaged. Okay. So we go now to the accounting records. Okay, so here, this is the recording of our financial transactions. So how do the entity record their business or financial transactions? So basically, we have here the manual system of accounting records. So this is the traditional recording. Okay, so basically, if the entity is not able to afford for a computerized system of accounting, so they will use the manual system of accounting. And also, if the entity is utilizing a computer, okay, so they somehow use a little of our manual system, okay, especially if they are just transitioning, because this will help especially for the auditors, because in a manual system there are audit trails. Okay, so we will be talking about that also later. So here, for the manual system accounting records, so we have the source documents. Okay, what are the source documents? So you are familiar with this already. When we say source documents, normally these are used to capture and formalize transaction data needed for the transaction processing, or in other words, these are the source or the proof that a transaction did really did happen. Okay, it's an evidence of a transaction. Okay, so aside from the source documents, we also have the product documents. So what are product documents? These are the result of the transaction processing. Okay, for example, payroll to the employee, okay, or uh, cash, uh, or the receipt, official receipt for the sale of good or service, okay, to the customers. So uh, this is the also a form, I mean, of a source document, but we can have it at the end of the transaction process stage, whereas your source document is in the beginning of the transaction. So source documents are needed before a transaction can be processed, and once a transaction is processed, so before the transaction can be completed, we can have these product documents as another source of financial information or transaction that will be recorded in the books of our accounts. Okay. We also have the turnaround documents. So basically, this is a product document of one system that becomes a source document for another system. So meaning, a product document is, it can be used in one or more transaction cycles. Okay, for example, um, a document from the processing or conversion cycle, which involves the costing of the product. So this will be used in uh, fixing the selling price of a product, which will be then under the revenue cycle. Okay, so there, um, a, uh, an official receipt will be received upon the sale of the good, and then this official receipt may contain the the selling price of the product, which will also be used later on in accounting for the cost or how much was the markup, okay, for the product, so that the entity will earn a profit, okay, and so on. So basically your source document, product document, and turnaround documents are the source documents, okay, but they are generated in different stages of the processing or the transaction cycles. So this is normally what we consider as the proof of that the transaction has taken place. Okay, another is we also have the journals. Okay, so you are familiar with this. This is a chronological record of our business transactions. We also have the special journals where the specific classes of transactions are classified and recorded accordingly. Okay, so you can base that also on the transaction cycles. Another is the register. So here we have, this is often used to denote certain types of special journal. So we have the payroll register. Okay, this is also known as our payroll journal. So it may also be the same as our journal. Okay, we also have the general journals. So these are non-recurring, infrequent, and dissimilar transactions. Basically, your general journal is used if you are using also the special journals. And we also have the ledger. Okay, so ledger, this is a book of financial accounts where we classify our transactions according to their nature, okay, or classification. So this is based on the, or you can use the basis on the list of chart of our accounts. Okay, so we also have the subsidiary ledgers, which supports the main account. Okay, meaning this shows the activity by detail for each account type. Okay, so these are the accounting records, okay, that we normally use under the manual system. Okay, so basically here we have an example of the flow of information from economic event into the general journal. So how do the entity or what is the flow, okay, or how to illustrate the flow of the financial transaction or economic event, okay, to be recorded in the journals up to the general ledger. So this is how it looks like if you will illustrate it. So first, of course, there will be a customer's order. Okay, so from there, normally the customer's order, they have the source documents, okay, as well. So we will discuss this in detail in the specific transaction cycle topic, okay, that we will have later on. But for this example, of course, the first step is the customers, or in this case, this is the revenue cycle. Okay, so customers order, and then the entity will prepare a sales order which contains uh, the details, okay, of the item that the customer wants to purchase. So the quantity, the amount, the type, and so on, the price. Okay, and then the sales order will be used, okay, to record this transaction or sales transaction into our journal. So if you are using a special journal, so you will enter it under the sales journal. Okay, and then after that, after a certain period or after the accounting period, so we will post it in the general ledger, okay, for summarizing the accounts. Okay, and then aside from entering this sales transaction into our journal, we will also use the sales order, which is a source document, okay, to post it in our accounts receivable subsidiary ledger if in the case we extended a credit to our customer. Okay, so but basically this is a supporting account or record, okay, later on, especially if we will uh, try to or this is used, I mean the accounts receivable subsidiary ledger are used, okay, to or so that the entity will monitor how much would they collect from a certain customer and for how much and when. Okay, so of course the periodically or this accounts receivable subsidiary ledger, this is periodically reconciled in the ledger, okay, or to the general ledger to make sure that the uh, total or the sum, okay, of our accounts receivable subsidiary ledger reconciles with the general ledger account for the main account of accounts receivable. Okay, because again, as mentioned earlier, your subsidiary ledger is a um, detailed record, okay, of a certain account. Okay, so that's how it is used. So this is just a simple flow of information under the revenue cycle, okay, where we capture the economic event, record it, and finally post it into our general ledger. So this is an example of information system, okay, under the manual system of accounting. Okay, so we will discuss the accounting system for digital or in a digital system. Okay, so we will compare it with, or first, I mean, we will discuss and compare it with that of the manual system. So here, under the accounting records in a digital system, so we have here uh, the first step is sales order. So this is as a form of source document. Okay, and then from here, the entity will key this or they will input this source document into the computer. Okay, and then they will have this sales order filing. Okay, so basically it needs to be filed later on for audit trail and for recording purposes if there are any deviation or error. Okay, so normally these are filed. Okay, and then from there, when this data or source document, the sales order is uh, the data from here was keyed in to our accounting or to our computer system. So our program in the computer will be updated. So in the program there we can have or we can generate the credit file if this sale is made on credit. We can also have the journals there. We will also have the error file. Okay, and basically the general ledger, okay, will be created as well in the database using the database in our computer. Okay, and we can also create a subsidiary ledger which is a link, okay, from the uh, general journal or from the journal or the archive. Okay, and inventory subsidiary as well. Okay, so meaning if there are sales, the entity can record not only the accounts receivable or the cash, they can also update their inventory because of the sale. Okay, so we have here this explanation of the steps in the figure. Okay, so from our general ledger, we can also create our uh, financial statements. Okay, so our general ledger is our master file. So we have here the explanation of the steps in this figure. So the first step is we will compare the accounts receivable balance in the balance sheet with the master file and the accounting record or accounts receivable control account balance. So this is to make sure that they reconcile. And in fact, this is just linking of the different accounts and their location. So basically, error is minimized, okay, because this is digital. Second, we will also, or the entity can also reconcile the accounts receivable control figure with the with its subsidiary account total. Okay, after that, they can select a sample of update entries made to the accounts receivable, and they can also trace these transactions to the from the sales journal or from the archive, okay, that they filed earlier. And number 4, from the sales journal entries, they can identify source documents that can be pulled from their files and use it for verification. So if necessary, also to confirm these source documents by contacting the customers. So basically, this accounting records in a digital system is not only helpful in making the recording efficient, it can also help in the audit trail, but they have to make sure that the entity uses the documents alongside with the computer systems, okay, because in some cases the entity disregards the use of the source documents, which makes it difficult for them to verify and to have the audit trail for the auditor later on. Okay, so this is how the accounting records is in a digital system compared to our manual system. Okay, so if you could notice, there are a lot of steps here, but it's much easier, okay, for recording transactions in a digital system. Okay, so those are for the accounting records in a digital system. Okay, so we will continue with our discussion for audit trail in the next video lecture.